Pleasure to see so many known names, friends, colleagues, students. I see names from Spain, from UAE, of course, from Japan, from the United States, from France, from many other countries. So very welcome. Thank you very much for giving this time of the day. Really appreciate this opportunity to talk about finance and to talk about becoming financially independent. Now, when we are talking about financial independence, the first thing that comes to my mind is how much time we spend working every day, every week, in order to bring a salary home, and how little time we invest in making sure that this money that we work for it very hardly, we invest it wisely. We save it and we invest it wisely. So it is important for every one of us that we work hard to be able to manage our money in a smart way. And today's seminar is going to have two parts. The first one deals with increasing awareness of the fact that we have to manage our money. And the second part will deal with strategies to become financially independent. Those are the two elements that we will be talking about the seminar today. So we are going to start first with the first part of the seminar, which will deal on how to invest our money, where to invest our money, and when to invest our money, and to become aware on the importance of money management for each one of us. So I want to start asking one question. And the first question I want to ask is, how many people want to be rich? In the top of your screens, you can type on the chat, or you just can raise your hands. How many people do want to be rich? And probably there are many hands standing up saying, I want to be rich. Okay, and this is fine. But the issue is, how many do you really want to get rich? And the second question is, what did we do today to be closer to becoming rich? Did we do something specifically today to achieve this goal? What did we do yesterday to try to achieve this goal? And what will we do tomorrow in order to gain our financial independency? Those are the key questions. Would we like to be the owner of Amazon? Would we like to be the owner of Google? Would we like to be the owner of Tesla? We have to know that we can be owners of these great companies, and that being owners of these great companies will take us one step closer to financial independence. We all have wishes. We all have wishes. But we must follow those wishes with actions. And those actions have to be daily, weekly, consistently, until we achieve our goals. Because we have to build our financial structure day after day after day. Now, here we have some life choices. And life is all about choices. We can buy our time, or we can buy our toil. When we are children, we all enjoy to have toys. Of course, we enjoy to have toys. But when we are adults, we also do enjoy to have toys. The only difference is that our toys become a little bit more expensive. Instead of this small car that we play with it all day, we want the big car. When we are old, we want the big thing. We want the Louis Vuitton bag, which costs $2,500 or 16,000 dirhams nowadays, as I've been told. Or we can buy the Louis Vuitton share, a piece of the Louis Vuitton company, for $125. We can buy the best Apple AirPod Max for $549, or we can buy a share, a piece, be the owner of a piece of Apple. We can buy the PlayStation 5 for $500, or we can buy Sony shares. We can buy the Air Jordan shoes for $500, or we can buy a piece of Nike, the company Nike. So if we are using our paycheck to only buy material things instead of buying assets, we are going to work until the day we die. And there is only one letter difference between owning and owing, but it is very important to know the difference and to understand that owning will bring us to financial independence, and owing will make us a prisoner. Okay, let's keep going. The problem is we buy things we do not need with money that we do not have in order to impress people who do not care. And this is one of the major problems that we have in this society, especially with social networks that oblige us to have a certain specific type of life. So let's go for another question. And the next question is, what do rich people buy? What do rich people buy? Well, the answer to that is very simple. Rich people buy things that they can afford. If you see the life of the real rich people, and we are talking about Mark Zuckerberg, we are talking about Elon Musk, we are talking about super rich people, they buy things that they can afford, and the rest they invest. Okay, we can think, excuse me, but I struggle to save money every month. It's almost impossible to save money every month. And it is very understandable, this feeling. But then, if it is difficult to save money every month, it is even more important that we manage our money wisely. Now, what kind of rich person do we want to be? Because there is a great difference between being rich and being wealthy. Being rich, simple, to have a lot of money. Being wealthy, to have the control of your life. A wealthy person has the control of their life, and they can do whatever they do want, whenever they want to do it. That's the main difference between being rich and being wealthy. So think what you want to be. You want to be rich, or you want to be wealthy? And there are many ways to become rich. Many, many ways. We can start a business, a new business. Oh, I have to put down $1,000 to start a new business. This is too much. But we will buy a new iPhone for $1,000. This is no problem. Healthy groceries, $100. Too much. But dinner and coffee, $100, no problem. We will watch Netflix for 2 hours. And after we watch Netflix for 2 hours, what will we say? One more episode. Let's watch one more episode. But to learn a new skill for free in YouTube with videos, 2 hours, oh, I don't have time to learn a new skill. So life is about choices. We should stop blaming the lack of opportunities and start thinking the amount of opportunities that we have in front of us. Now let's talk about bad investments. And before talking about bad investments, I just want to make sure that we have everybody here. Perfect. So before talking about bad investments, let me share with you. This is a beautiful Nissan Patrol Nismo, the top of the top. And when somebody buys something very nice, they like to show us their new car. They are so proud that they own this Nissan Patrol that costs 400,000 dirhams, $100,000, V8, fully equipped. Wonderful. This is wonderful. But it is not a good investment. And suddenly, after 2 months, we are asking, what is your car? And say, oh, I only drive it on the weekends because it consumes too much petrol. Okay, if it is pocket money for you, it is no problem. Buy the car that you want. But if it is the bulk of your money, we shouldn't do this type of investments. Let me put a more clear example. There are 2 scenarios when we are spending money. And this is my favorite car at this moment, the Range Rover Velar. I love this car. I love it. And there are 2 scenarios when spending money. We can buy our dream car, whatever is your dream car. My dream car at this moment is this Range Rover Velar, 340,000 dirhams. Okay. After 7 years, the car is worth 90,000 dirhams because of the depreciation. There has been a net loss of 250,000 dirhams, plus the expensive gas, the insurance. So for a total loss of 290,000 dirhams. So we spent 340,000 dirhams, and after 7 years, we are left with 50,000 dirhams value. Not a good investment. Second scenario, we can buy a 10-year-old Kia Rio for 5,000 dirhams, or maybe you are lucky and have amazing friends, as I have, and they give it to you as a present. You can invest the rest 335,000 dirhams for 7 years, a 10% average return on the SP 500, and the result will be that you have nothing more and nothing less after 7 years of 690,000 dirhams in your bank account. Now you can buy the Velar, and you still have over 350,000 dirhams in your bank account. So it's just a matter of time. Just a matter of time. Because if you drive the car that you love to the job that you hate, you are a prisoner. Not a successful person, but just a prisoner. Let me put a more clear example about that. I have noticed that so many people love iPhones, and this is great to have the latest iPhone. Wonderful. In our life, we can purchase 4, 5, 6, 7 iPhones at a price around $1,000, 1,000 euros, 4,400 dirhams, times 5 iPhones. This is about 22,000 dirhams that we spent in the last 10 years. The alternative is that we could have bought Apple company, pieces of Apple company 5 years ago at $30 a piece. And we would have right now today 733 parts of ownership on Apple. Times $170, which is worth today, we would have had 125 dirhams today in our bank, compound dividends 132,000 dirhams in our bank. So we could have 5 old iPhones, or we could have 135,000 dirhams in our bank. This is the difference between managing our money. So please be the person with the $100,000 in the bank and a $5,000 car, not the person with $5,000 in the bank and a $100,000 car. Investing terms that we should know about. A stock is a small piece of ownership of a company. We can be the owners of Coca-Cola. We can be the owners of Starbucks. We can be the owners of Google, just buying a small piece of each of these companies. This is a stock. And an index is a collection of companies that represent a part of the market. Maybe you have heard about the SP 500, maybe not, but the SP 500 is the index that represents the best 500 American companies in history. And we can buy the best 500 companies in American history just with one click because somebody has put them together for us. Now, this seminar is not about telling you or asking you what is the hottest crypto or the hottest stock, what is the best stock. I don't know. I have no idea. This is about changing our relationship with money and investment. This is about just generating a new mental map via the 4 following strategies: timing the market, diversification, dollar cost average, and investing on an index. So this is the first part of the conference, just the first part of the conference, in which we just want to be aware of money management and how we have to be aware that the decisions that we take in life will take us closer to our desired outcome, which might be to become wealthy, or maybe to become rich, or maybe just to be independent. So let's go for the second part of the seminar, in which we are going to be talking about specific strategies that can take you closer to this goal. Okay, let's go with it. The first thing that we have to know when we are investing is that there is always risk associated with investment. Every time we take a risk, we might have a higher return, the higher the risk, but there is always a possibility of having risk. Nevertheless, the biggest risk of all is not taking any risk. The biggest risk is not to do anything, because there is a silent killer. There is something that affects all of us. And if we don't do anything about it, we will be losing money every day, every week, every month. And this silent killer is called inflation. A toy in 1970 was worth $10. The same toy, exactly the same toy today, costs $76, $77, $67. Because inflation is destroying our savings. $100 in the year 1900 is equivalent to $3 right now. What do you mean about that? Well, $1 in 1900 was enough to buy movie tickets for the entire family. $1 in the 1900s was enough to buy 7.5 pounds of steak. If we go to the movies today with $1, with all the family, we are not going to get even popcorn. This is what happens when we don't move our money. This is what happens when we only save and we do not invest. And why is that? This is because 22% of all the dollars printed in history have been printed in the year 2020. And 40% of all the dollars printed in history have been printed in the last 2 years. The more amount of money in the market, the less the value of our money. So we have to invest just to keep our purchasing power. Now, this is not the first investment strategy. This is the first step to invest. The first step to invest is to choose the right bank. Yes, to choose the right bank. Because whenever we go to the bank, we can pay for the same product in commission or in fees, a 1% fee, or a 2% fee, or a 3% fee. Every bank charges different fees for different products. And that might seem a little or a small amount of money, but in a 30-year saving life, a 3% fee for a $1 million investment will get returned $2.8 million. A 2% fee will return $3.7 million. But if we can get a 1% fee, this $1 million will become almost $5 million. Only choosing the right bank, only choosing the right product. There is a difference between $2.8 million and $5 million. And this is a huge difference. So the first step in investing is to choose the right bank. This is the first thing that we should do. Okay, we might be afraid to invest in the stock market. Let's look at some data from the stock market. What has happened in the stock market in the last few years? We can see here the green line, and this green line is the amount of years that the stock market has been positive. And this is the amount of years that the stock market has been negative. And we can see that there are many more years where the stock market has been positive than the number of years that the stock market has been negative. So this is a small guarantee. But you can say, excuse me, when I see the stock market, I see that the price goes up, then the next day goes down, then it goes more down, then it goes up. Yes, it is true. This is what happens when we see a 1 month. 1 month. Yes, in 1 month that can happen, and that will happen. But if we look at the long range, at the maximum amount of time that we have had the stock market, we see that the trend is clearly up. Even if we are the best, the worst investor in life, the worst investor in life, even if we have invested our money here, we would have multiplied our money by 5 times. Okay, imagine that we invested our money here. That's wonderful. We have increased our money by 7 times. Here, 5 times. Here again, 7 times, 8 times. This is the 2008 crisis, by the way, what we see here. This is the 2000 crisis here. This is the coronavirus crisis. Imagine that we were invested in the worst moment before coronavirus, and then the market went down 60%. Today we would have double our money, even if we had invested in the worst moment. The problem is that we want to become rich today and with little effort. And it is very difficult to become a millionaire just in a little bit of time. But it is easier if we have time. Time in the markets beats time in the markets. We will talk about that a little bit later. We can say, excuse me, but I'm too old to wait for 25 years to become rich. Well, it is true that the best moment to start investing was yesterday. Yes, yesterday was the best moment to start investing. But the second best moment to start investing, it is today. Again, the problem is that we want to become rich today and with little efforts. Okay, do we want to become rich very fast? No problem. We go to the bank, we ask for 100,000 dirhams, $25,000 euro loan, then we buy the newest coin, Dogecoin, whatever coin, for 1 dirham. When the Dogecoin reaches 1,000 dirhams, we will have 100 million dirhams. Perfect strategy, no problem. Well, the only problem is that we have a 0.00001 chance of becoming a millionaire, a 99.9% chance of ending with a huge debt. I am a believer in blockchain, I am a believer in cryptocurrency as an investment, as part of a well-planned strategy, but not as a wishful thinking, not just as a gamble. If we want to know how to make money with Netflix, it is very easy. We just need 2 steps to make money with Netflix. Number one, cancel your subscription. Number two, go back to work. This is the fastest and easiest way to make money with Netflix. Now, let's be serious about it. Those are the 20-year annualized returns by asset class. So this is what we would return, what we would get back in our investments if we would invest our money in different assets. The average investor gets a return of 1.9% per year. Yes, we hear all these people that say, I have doubled my money, I have tripled my money. Well, financial data tells us that the average investor makes 1.9% per year. And the goal is to beat inflation, which is 2.2 per year. Now, inflation in Europe is about 7, 8, 9%. Inflation in the United States is 7, 8, 9%. So we have to beat inflation every year. If we buy a home, we will get a return of 3.4, around 3.4 per year. If we invest in the European stock market, we will get a 4% return every year. If we invest in bonds, government bonds, we will get about 4.5%. If we invest 40% of our money in bonds and 60% in the stock market, we will get a 5%. 60% in the stock market, 40% in bonds, we will get a 5.2%. If we invest in the SP 500, around 5.6%, discounted inflation. Invest in oil, 7%. Invest in gold, 7.7%. Invest in rates, real estate. And when we are talking about rates, real estate, we are talking about companies that invest in real estate, not buying homes, but companies that invest in real estate, we will get almost 10% return on investment. So the 4 strategies to become financially independent: time in the market, diversification, dollar cost average, and indexing. Let's go one by one. The number one, time in the market. Time in the market means always we have to be invested. Doesn't matter if there is a crisis, if there is a recession, if there is a war, there are many things happening around the world every single day. We have to be in the market always. Why do we have to be always in the market? Because if we only are one day in the market, we have 54% chances of having a profit and 46% chances of losing. If we are 1 month in the market, we have 38% chances of losing. If we are 1 quarter in the market, our chances of losing decrease to 33%. If we are 3 years in the market, the chances of losing decrease to 17%. And we are 6 years in the market, always in the market, our chances of losing are just 6%, which means that we have a 94% chances of winning. The more we stay in the market, the more our percentage of chances increases of winning. So this is why it is so critical, so important to be in the market. There is never anything guaranteed when we are investing. And please run away from anybody that tells you that they guarantee you a certain amount of money. No, there is no such thing as guarantee. What we can do is to increase our chances of being successful. Please stop buying this. Not good for your pocket, not good for your health, and start investing in this. You can do whatever you want, but you can buy a Mac, a Big Mac, or you can buy a share of McDonald's. You can buy a Coca-Cola, or you can buy a piece of Coca-Cola, a piece of the company of Coca-Cola for $50. You can buy a pizza or a Pepsi, or you can be the owner of Domino's or Pepsi Cola. You can buy for a coffee or a Starbucks or a tea or a carrot cake, or you can be the owner of Starbucks. Whatever you choose is your choice. Now, people might be thinking, but I have heard that the market has collapsed many times. Those are the amount of times that the market has collapsed. In 1929, 86%. People were jumping from the balcony. At the end of World War II, 30%. 34% in the 1987 crisis. In the tech bubble of 2000, 49% the market fell. In the 2008 crisis, 57% the market fell. After the corona crash, 60% the markets collapsed. So why should we invest in the market? Well, because after an 86% loss, there was a recovery of 129%. a recovery of 158%, a recovery of 267%, a recovery of 413%, a recovery of 326%, and after the Corona crash, people who invested after the Corona crash, they are doubling their money. So yes, there are big losses accompanied by much bigger gains, much bigger gains. So patience is everything in the stock market. Strategy number one, be in the market, be always in the market, have a long-term orientation. Strategy number two, diversification. We should not put all our money in one type of shares. We should not, Coca-Cola is my favorite company, I will buy everything Coca-Cola. No, I want to buy everything from Apple. No. Diversification means that we have to invest in different types of assets. And the different types of assets that we can invest are gold, and have it in your hand, bonds, stocks, cash, and real estate, always real estate. Each type of investment works for different times. When there is inflation, we buy gold. When there is deflation, we buy bonds. When there is prosperity, we buy stocks. When there is a recession, we stay in cash. And every time we buy real estate, because this is the asset that holds better in every recession. Now, I want something simple, please. I don't want to be thinking that I have to invest this every time in these assets. Okay, this is something simple, and it's called the all-weather portfolio. They call it the all-weather portfolio because it works when the economy is good, when the economy is bad, when the economy is going sideways, and it gives a very good return. And it says you should stay around 1/4 in cash and 1/4 in stocks of all your savings, around 20% in bonds, around 20% in real estate, and about 15% in alternative investments, as it can be cryptocurrencies. Because this will work when there is a good market condition, this will work when there is not a good market condition, this will always work, and this will help you when you need cash to pay for the studies of your son or your daughter, for doing an alternative investment. So this is called the all-weather portfolio. You do it once in your life and you forget about it. Once in your life, you create this portfolio and you forget about it. In another seminars, we could talk about how diversification works, and obviously, if we are 30 years old, it is different to invest when we are 30 years old because we can take much more risk, invest more money in the stocks, but when we are approaching our retirement age, we should be much more conservative, and we can change the amount that we invest in each of them. Okay, but this goes for a deeper thought process. Strategy number 3, dollar cost average. Strategy number 3 replies to the question, when should I buy? When? Should I buy here? Should I buy here? Should I buy here? Should I buy here? Doesn't matter, because nobody knows the future. Nobody knows what the stock market is going to do tomorrow, 1 week from now, one year from now. So the dollar cost average strategy, what it tells you is, take the same amount of money and invest it every day or every week, the same day of the week or the same day of the month, and you say, I want to buy 1 Coca-Cola share the 24th of each month. And sometimes you will buy the Coca-Cola share when it is here, other when it is here, other when it is here. Okay, but at the end you will buy the average price of Coca-Cola, and you will never have to worry when to buy, because you will always be in the market. So the moment you receive your salary, you set apart what you are going to say, you give an automatic order to your bank saying, automatically, the moment that my salary comes, buy 1 share of Apple, put this money in Coca-Cola, put this money in immediately. And this is what we call dollar cost average. Why do we use dollar cost average? We use dollar cost average because we want to take emotions away from the decision process. One of the key elements, and we could talk very much about that, is how to control your emotions when you are winning a lot of money and when you are losing a lot of money. So dollar cost average allows us to eliminate emotion from our trading and from our strategies. So dollar cost average is the third strategy when we are investing. So strategy number one, always be in the market. Strategy number two, diversification. Buy different type of assets. Strategy number three, dollar cost average. Always be setting aside your money and give automatic orders to buy. Strategy number fourth and last strategy, indexing. What does it mean, indexing? Indexing means that there are very smart people out there that have done the job for us already. They already have done the job for us. They have selected the best companies and they have put them together in a package, and we can buy this package. For example, this is the Standard & Poor's 500. If we buy the Standard & Poor's 500, we will be buying the 500 best American companies, the biggest ones. And we will be following an indexing strategy, and we will be following a diversification strategy, because we will be purchasing technology, consumer discretionary, healthcare, banks. This is what it is inside this specific index, which is called the SP500. We can find Apple, we can find Microsoft, we can find Amazon, we can find Google, Tesla, Facebook, Nvidia, Berkshire Hathaway, United Health Services, JP Morgan, Johnson & Johnson. So somebody has done the amazing job of putting all these best companies together so that we can buy all of them with one click. And this way we are doing diversification and we are doing indexing. Now, you say, excuse me, I don't want to buy the best 500 American companies, I want to buy German companies. Okay, somebody has done an index with the German companies. Somebody has done an index with the Chinese, or the Japanese, or the British, or the Hong Kong, or the South Korean companies. You can choose where you want to invest your money. You can choose in which sector you want to invest your money. And by indexing, we can see a picture here of what amount of Google you are buying, what amount of Amazon, what amount of Apple, what amount of Microsoft. And every day you can follow your investment. The ones that are in green are going up, the ones that are in red are going down, and you can have a perfect view of what you are buying at every single moment. Now, these strategies have tremendous synergies. Time in the market, always be in the market. Always be in the market. Dollar cost average, always buy every month. Buy every month. Diversifying, buy different assets, real estate, bonds, gold, stocks, cryptos, alternative investments, and indexing, relating your investment to an index. Those strategies will take you everywhere. And this is the road to financial independence. Now, Charlie Munger, a person who is now 98 years old and still working because he loves his job, he tells us, with 98 years old, the big money is not in the buying or selling, but on the waiting. And Warren Buffett, one of the best investors of all times, 92 years old, still working because he loves his job. He says, we don't have to be smarter than the rest. We just have to be more disciplined than the rest. We don't need to be smarter. We just need discipline. If we have the discipline to follow those 4 strategies, nothing is guaranteed, but it seems that you have a 94% chance of achieving your goals. Now, let me finish with this. If you invest $30 a week, $30 a week, wait a second, $30 a week, which are more or less 15.7 dirhams per day. For my friends in the United States, in Europe, this is about 4 euros per day, 3.7 euros per day, around $4 per day. If you invest this per day, which is more or less what a Starbucks coffee costs, after 1 year, you will have $2,000, over $2,000. After 5 years, you will have $13,000. After 10 years, you will have $34,000. After 30 years, you will have $357,000. just by investing 15 dirhams per day, just by investing $30 a week. No, we don't need huge amounts of money. What we need is strategies and discipline, time in the market, diversification, dollar cost average, and indexing. And this will be the result of your investment. One final thought. They look very similar. They look very similar. They are made of steel, they are tall, they are slim, they are quite similar. But one is the real one and the other not. So we can buy a bad company at a good price, or we can buy a good company at a very bad price. Make sure you always buy the good company at the bad price. Make sure you always buy the good company. This is the same thing that we are buying a good car, or we are buying a good bag, or we are buying a good computer, or we are buying in the stock market. When we are investing, we have to buy quality. And to answer the question what quality is, we only have to answer one question. Do you think this company will be here 10 years from now? Do we think that Google will be here 10 years from now? Do we think that Amazon will be here 10 years from now? Do we think that Johnson & Johnson will be here 10 years from now? This is the only question that we have to answer and apply the strategies on top of these 4 strategies. Now, time in the market, diversification, dollar cost average, and indexing. This is the road to investment, so let's invest wisely. This is the road to financial independence. I think we have taken the time, enough time, 40 minutes. I really thank you for being here today. I really thank you for giving us the time and sharing this with us. And now we are open to any question that you may ask. Thank you very much. We open the floor for any questions. Thank you.
Thank you, Dr. Alberto, for this very informative presentation. You give us very rich information specifically about the strategies that we can follow in order to be financially independent. Specifically time in the market and diversification and dollar cost average and indexing. And I think the idea is straightforward. It needs somebody to be very disciplined and very serious about going into that road. And I think it's a road of success if people really stick to these strategies and try to just stick for it and go ahead with it. Thank you so much again. And I'm going to kick this discussion with a question. My question is, does national culture affect investor attitude toward this financial risk in a country like UAE? So this is a starting question for discussion, and then after that I'm going to open the floor for the rest of attendees to raise their question. Thank you, Doctor.
Thank you very much, Dr. Abdallah El-Amin. Thank you. This is such an interesting question. Before I answer this question and we put it together, I just want to thank so much Dr. Ahmed, yourself for preparing the conference, Dr. Tarek, and my family who is watching, my nieces, my sister, of course, my sister and my friends, my brother-in-law, and I see names from Japan, from Germany, from Spain, from the UAE. So I just want to thank them because the timing is very complicated for them and all my friends from the UAE. Thank you very much. Your question is very relevant. Does culture affect investment? Yes, culture affects investment very much because there are some cultures that like more certainty and others who are more afraid of uncertainty. So there are cultures that are more prone to take risks, and there are cultures that are less prone to take risks. So culture has a very interesting aspect when we are investing, and we can say that cultures that are more prone to take risk, they invest much more in the stock market, like United States, Northern European countries, English-speaking countries. They are more prone to invest in the stock market because they are willing to take more risk, while Mediterranean countries, Middle East countries, the aversion of risk is much higher. So it takes a little bit more to take this risk. Although we have to understand that the real risk is not to do anything, especially now with inflation almost touching double digits, with this that has not happened since the last 30 or 40 years. So the biggest risk is not to do anything with our money right now. This is the biggest risk, because every year we are going to be poorer. If we have $10,000 in the bank, next year we will have $10,000 in the bank, but we will be able to buy 10% less because of inflation. If we would go to the bank next year and instead of having $10,000, we would have $9,000, we would say, oh my God, I have to do something with my money. But inflation is a silent killer. It's a real silent killer. And this is why it is more risky not to do anything with our money than to do something with our money. Thank you very much for your question, Dr. Abdallah. Thank you very much.
Thank you so much, Dr. Alberto. Now the floor is open for attendees, and also welcome everyone to this seminar, specifically our guests from Spain and Europe and USA and Japan. You are most welcome in our seminar at the College of Business Administration. The floor is yours now. If you do have any question, just you can directly either to raise it, or you can use the chat if you want to as well. Thank you so much.
Yes.
So according to the order of hand raised, we have question from Mohammed Al-Kindi. Mohammed, اتفضل سؤالك للدكتور ألبرتو.
Yes, please.
Yes, good evening, everyone. Thank you, Mr. Alberto. And there is a famous sentence, Dr. Alberto. It's called, "In a crisis, wealth is created." I don't know if you agree or not. So my question is, how we can select the best growth stocks? For example, for beginners, if you are going to, for example, to go through stocks market, how we can select the best growth stocks?
Okay, thank you very much, Mr. Mohammed, and thank you very much for your question. We totally agree that crisis, in fact, in Chinese, when we try to translate the word crisis, it means crisis and opportunity. And the big fortunes are done in crisis time because it is the best time to invest. Now, your question is also very interesting. Which stock to select? Which stock to select? And if I would have an answer here, it would be amazing. And I don't have an answer for that. What I can answer for you is, we have to buy something that we know about. So if somebody comes to us and they say, oh, I have this company that is called Fortinet, we should invest in Fortinet. What is Fortinet? I don't know about Fortinet. Oh, it's a security company. I don't know anything about security. I don't understand anything about computer security. I'm not going to invest in anything that I don't understand. But I might be a consumer of Apple. I might be a consumer of Facebook. I might be a consumer of Amazon. And I understand Amazon. I do understand Amazon. And we do understand Apple. We understand what Apple does. So the first thing is that we have to invest in something that we know and we understand. That's the first thing. And the second thing, there are very smart people. For example, the question that I would answer is, do you think Coca-Cola is going to be here 10 years from now? Do we think that such a company is going to be here 10 years from now? Do we think that Johnson & Johnson is going to be here 10 years from now? I think this is the number one question that we have to answer to ourselves when we are going to invest. And the second, there are very smart people, especially people like Warren Buffett, Charlie Munger, Peter Drucker, persons that are all the day analyzing this type of companies, and they choose them for us. in an index or in a fund. So rather than, if our knowledge is very limited, there are very, very smart people that do the job for us. And we can follow them. Please do not follow these new YouTubers that are, you know, every day saying the world is going to collapse tomorrow, and we click to see how the world is going to collapse tomorrow. Forget about these YouTube videos that they are claiming that the collapse is imminent every time. So the answer for that would be, one, select companies that you know about, that you are a user or that you are a customer of. Two, select companies that you think that they are going to be here from now on 10 years. That would be my best answer, Dr. Mohammed. Thank you very much. Thank you.
Thank you, Dr. Alberto, for this answer. Now let's go to the second question by Sarah Msabbah Al-Yamahi. Go ahead, Sarah, ask your question for Dr. Alberto.
Well, I just wanted to start off by saying thank you for the session. It was truly informative. I have a question that's been going on in my head, and this session came in the right time to answer that. So my question is, with the upcoming trends in investment like NFTs and cryptocurrency and all of that, so would you recommend or would you advise us to be the pioneers and go ahead and invest in these new trends, or should we play it safe since, as you said, knowledge is a key aspect in investment and one of the key steps that you need? So should we be the pioneers and follow the trends, or should we play it safe and see what happens and take the step after that? What do you think?
Thank you very much, Sarah, for your question. Very interesting. Thank you very much. The answer would be, first of all, we have to invest the money that we can lose. And second, in new assets like NFTs, cryptocurrencies, we would invest the money that we do not need and never more than 5% of our total investment. Because we want to sleep well at night, Sarah and everybody else. We don't want to be looking at the screen of our phone every day saying, oh, Bitcoin has gone down 30%, now Bitcoin has gone up 25%. We want to sleep well at nights, and we want to sleep safe. And if we invest 5% or less of our money, of all our investments, in this type of new trends, it's fine. Because if we lose this 5%, total, absolutely, we lose this 5%, we are not going to be broken. But if we invest 60, 70, 80%, the people that calls and says, Alberto, I have just saved this amount of money and I'm going to put it in this. Well, you just spend so much time working to invest this, to save this amount of money. And my thought is, it's not the money that we make, it's not our salary. It is the amount of time that takes us to save money. So we have to be very careful with the management of our money. So the answer to that, Sarah, would be invest less than 5% of your total and make sure that you know what you are doing, in the sense that NFTs, I wouldn't give recommendations on NFTs. I know very little about NFTs. I stay with cryptocurrencies, and I stay with the cryptocurrencies that are the ones that are most well known, especially Bitcoin and Ethereum. Everybody can have their choices, but just money that you can lose and less than 5% of your total wealth. That would be my answer, Sarah.
Thank you so much, Doctor.
My pleasure, my pleasure.
Okay, let's go to the next question by Mr. Abdurrahman. You can proceed.
Hello, Doctor. How are you?
Great. How are you?
I'm good. I have two questions.
Yes.
First is, how do we find the best platforms to invest on? Like, what do we look for?
Okay.
Is it fees rate or anything else we need to pay attention? And the second question, there was a YouTube video I saw. A guy made a monkey pick at random 10 stocks from the top 1,000 stocks in the US. And the return he made after 1 year beat all of the stock market.
Yes.
experts.
Thank you very much for that, Abdurrahman. Thank you very much for the two questions.
Yeah, the second question is, what do you think about randomizing our picks?
Wonderful.
Stocks?
Randomizing. Thank you very much. Thank you very much, Abdurrahman. Great questions. Great questions. The number one about the best platform. Remember the first step when we say forget about the strategies now, let's go to the first step. The first step is to have a broker that is the one that has the lower fees. Number one, Abdurrahman and everyone else. It has the lowest fees and it gives us the security that it is not in some fiscal paradise, that is not, and I can give you some names. I can give you some names. The one that I'm using is Interactive Brokers. The one that I use is Interactive Brokers, international broker with the lowest fees and great security. This is one. There are many others. But the answer to the first question is the one that gives you the greatest security, that it is based not in a fiscal paradise, and that is internationally well known. In this case, Interactive Brokers, there are others. The second question, the monkey experiment is a well-known experiment, and this is wonderful experiment in which they have a monkey throwing darts into a board where there were names of assets, Coca-Cola, Apple, Facebook. Okay, and the monkey would choose the companies just, let's say, randomly. The monkey beat the market. The monkey beat the best experts of JP Morgan, of Morgan Stanley, the professional brokers. The monkey beat the brokers. Yes. When the stocks were going up, when the stocks were going down, the broker was a little bit better, but only a little bit better. This is why I always say we have to take charge of our finances, because nobody knows what is going to happen tomorrow. Nobody. So the important thing is that you follow these strategies, and by following these strategies, diversification, that means I might buy Coca-Cola, I might buy Apple, I might buy Berkshire Hathaway, I might buy, okay, I have these companies with an index, with a dollar cost average, and well diversified, because I also have some crypto, and I also have some bonds, and I also have some real estates. This is how what we are doing really is randomizing our investment, but with a strategy. Abdurrahman, we are randomizing our investment, but with a strategy. So yes, this is why I will never pay fees to anybody for investing my money, because there is no guarantee that they are going to do it better than me. I am tired of seeing my friends. No, I'm not tired to see my friends. I'm tired to see my friends complaining about the fact that their money is being swallowed by the bank fees. Alberto, I have this. I don't know why my money is not, because, well, I'm sorry, but they are charging you 2.5% per year. They are charging you 2.8% per year. So there are many things that we have control. There are other things that we don't have control. For the ones that we have control, we take action. For the ones that we don't have control, like what is going to happen tomorrow in the market, we make a strategy. And we follow those 4 strategies. Abdurrahman, I'm so happy to listen to you. Really, really happy to listen to you. I have to say that I miss you very much. And please keep in touch.
Okay, Doctor, thank you.
Thank you very much.
Dr. Alberto, nowadays people are using the social media extensively, and sometimes there is a lot of rumor and fake news spread here and there. And I believe that is usually make people very reluctant and hesitant towards investing their money in all these outlets, bond or stock, whatever. So do you recommend any strategy for our audience, so to use it in order to at least avoid these kind of fake news that may affect their decision?
Absolutely. And thank you very much to the persons that send me WhatsApp, send me emails saying, Doctor, there is this company in Bahrain or in Oman that is offering me this, they are offering me 10% fixed. Do you think this is? We have to forget about all these things. Anybody that guarantees you anything, just run away. Please, everybody. Anybody that guarantees you that there is going to give you a 10%, a 12%, just run away. It is impossible to guarantee a 10%, 12%. Impossible. So what do we have to do? We have to follow a strategy. But it is your strategy, Dr. Abdallah's strategy, Dr. Tarek's strategy, Abdulaziz strategy, Afra's strategy. It is your own strategy. You decide what to buy, and you decide when to buy. The important thing is that you do it consistently and with a discipline, saying that I am always going to be in the markets. I am going to be buying always. I'm going to do a dollar cost average, and I'm going to do it every month. I'm going to have different types of assets, and I'm going to index. You know, if we want to forget about everything, if we want if we want the simplest strategy, we go to the SP 500, to the best 500 companies in the world, American companies in the world. We go to the bank and we say, sir, every month I want you to take 5% of my salary and put it directly here in the best 500 companies in the world. And I can give you names of investment groups that are guaranteed, like Vanguard, Amundi, BlackRock. Those are Fidelity. Those are investment agencies and investment funds that they will only collapse if the entire planet collapses. But please, do not invest a single dirham, a single dollar, a single euro in companies that you do not research well. You have to do your research. But if you want something very simple, extremely simple and practical, you just go to the bank and you say, I want to invest my money in this index, SP 500 index. Please, every 24th of each month, take 15% of my salary and put it here. And then with 5% of your salary, or you can buy 1 gram of gold, 1 gram of the gold for 200 dirhams. You say every month I'm going to buy 1 gram of gold, 1 gram of gold, and you think that this is very little, and this is the part, and then you can buy a bond at some point, and then you can buy into a company that is a real estate. So, but it is you who has to be in charge of your finance. Don't let anybody be in charge of one of the most important aspects of your life. It is your life, it is your money. You need to take control of your life, you need to take control of your money with simple strategies. Today we have not talked about anything that we need to be a neurosurgeon in order to do it. We have talked about simple concepts that we can apply, and I will be happy to do another seminar. I will be happy to do another seminar to go in depth. I just wanted to know, for you to know these strategies exist and they are available to you. This was my goal. Thank you very much, Dr. Abdallah, for your thoughts and your question.
Thanks for the elaboration, Dr. Alberto.
Thank you very much, Dr. Tarek.
Now we'll go to the next question by Joel. Please, you can proceed and ask Dr. Alberto.
Hello, doctor.
Hello, how are you?
This was very educational. Just wanted to ask you, can you tell us something that you personally invest in?
I can tell you, Sandra, this is my very good friend Joel from India. I forgot, I didn't forget my friends from India, please, huh? I didn't forget my friends from India. Yes, something that I invest personally on. Well, I invest in good companies. I invest in good companies, I invest in gold, I invest in physical gold. I invest in cryptocurrencies, Bitcoin and Ethereum. I invest in shares, good shares. Johnson & Johnson, Apple, Amazon, Google, and I invest in bonds. And of course, I invest in real estate. I just invest in all the types of investments because we need to be diversified. Remember what we were talking before, that we need to be diversified. And in order to be diversified, we have to have a little bit of each type of asset. Which are those types of assets: stocks, bonds, gold, cash, and real estate. So this is what I invest in. This is what I invest in and what I've been investing in for the long range. Thank you very much for your question, Joel. Thank you. And thank you for being here. Thank you very much. Any other questions at this point? My God, we have been here for so long and nobody is leaving. I'm really thankful to you. Just really thankful to you for staying the whole time. Thank you very much. Dr. Abdallah, Dr. Tarek, Dr. Ahmed, if there are any other specific questions, we can have another seminar in another moment, for sure. It will be my pleasure. And can ask for later on for individual questions. It will be my pleasure, for sure.
It looks like we cover all questions, Dr. Alberto. Dr. Alberto, is there anything else you wanted to cover before wrap up?
I would like to finish with one last thought, and it is this one that I'm sharing right now. The same thing that happens in the real world, the same thing must happen when we are investing. Do not buy this, please. Buy this. Always buy good companies. Good companies. Answering the question, will this company be here after 10 years? Will this company be here after 20 years? This is the number one question that we have to ask. And I would like to finish just at this time of the day, during Ramadan time, so many people joining from Europe, from the US, from Japan, from India, from the United Arab Emirates, of course, from Sudan. Thank you very much. It has been a great, great pleasure. I'm really thankful. I'm really thankful, and I'm amazed that nobody left after over 1 hour and a half. So this is just amazing. You have been very kind. I would like to thank Dr. Abdallah Al-Amin so much, always, for the great questions and the discussion. To Dr. Ahmed Zain, obviously, always for his support, and to Dr. Tarek, always for organizing the seminars. To all my dear colleagues, my dear friends, thank you very much for being here. I wish you the best of the day, and I will be more than happy to continue this seminar on a second part or on individual basis later on. Thank you again, everyone. Have a wonderful day.